Okay, now we are looking at equity capital as a way to raise funds for a business. Normally, an owner, when he starts a business, usually puts in his own equity as seed money to start the business and start all the activities. But predominantly, that is normally not enough to continue the business and to develop it and take it to the next level. So there are other alternative means to equity capital, which include, common stock. Common stock, you can issue ordinary shares on the stock market in a publicly traded company, and then the end consumer, if they want to, can buy these shares and stocks in a company. Many companies have stocks, including Marks and Spencer's, Halfords, and BP, Shell. So you can buy shares in these companies, and then you buy at the market price, and those shares which have been issued by the company will receive that money. And then when the consumer decides to sell their shares, if they bought it at one price and now it's a higher price, then they can make a profit on that. Alternatively, if the company offers a dividend, then the shareholder gets back a part dividend for the number of shares that they own. Another way to raise money from equity capital is from venture capitalists. Venture capitalist firms may want to invest in various companies, and by investing in that company, they will take a proportion of the ownership of that business. So you give away part equity of that business in relation to the equity that the venture capitalist has given you. And another way to raise equity capital are with the use of warrants. In recent years, firms have considered equity alternatives to common stock. One alternative is for smaller companies anyway, is the issue of a warrant. Here, holders can purchase shares in the company with a fixed price, sometimes in the future, in return for payment for the warrant up front. So they will get a fixed payment in the future in return for that money coming in for that warrant up front. So when we're looking at equity capital, we can see the 5 main considering points is that equity can be one of 3 forms. It can be of owner's equity, venture capitalists, warrants, and common stock. You've got private equity. Investor or venture capitalist provides equity financing to small and often risky businesses in return for a share of the firm's ownership. You have to be careful not to give away too much ownership, otherwise you can lose control. The conventional way to raise equity in publicly traded firms is to issue common stock at the price of the market is paying for. We derive the warrant value from the price of the underlying common stock, and thus we have to treat warrants as another form of equity. And then finally, when we're looking at equity capital, when dealing with contingent values rights, investors have the right to sell stocks for a fixed price. Okay, so I hope we've touched upon some areas for equity capital. Thank you.